Afternoon, everyone. Welcome to this Lunch and Learn session on our Milestone 5. For the team, I know people are just joining now, and thank you very much for joining us today. So I'm really excited about this particular session, just because it's a really sort of challenging one. Even when we were designing the toolkit, it was really challenging to design, just because your business case is something you're working on the entire time. So where should it really fit in the whole sort of which milestone, and how do you sort of break it out when really you're working on it, as I say, within every milestone. But I'm really happy to say that we're joined today, and we're going to be walked through the whole process by two wonderful guests. We've got Allan Benhamou, Associate with Finance Earth. He's going to be talking to us about the Wildlife Trust Habitat Banking Investment Model. And we're also joined by Dillon, who's Director of Regenerate Outcomes, and you will probably know him as a fellow NERF participant around the development of the Hadrian Bond. So lots of learning to come today. Also, just wanted to flag up that Alison had, I know, posted a post on the Teams about sort of getting some feedback from you on whether these webinars, would you like to see them in a different format? Are they useful to you? In sort of part of as they're assessing the whole community of practice and how you're using it. So I know that myself and my colleague Phoebe would also really love to know what you're looking for, what you find helpful about these webinars. Why do you keep coming, and what can we do to support you more? So with that in mind, because I know we've got quite a lot to get through, and so we've only got two guests today because there is so much to get into the weeds on. We want to leave lots of time for a Q&A. So if I'm just going to pass right over to Allan, who's going to give us a presentation, and then we'll have a couple of questions before then we go to Tom and then open up to a broader Q&A. Thanks, Allan.
Thank you very much, Helen, and hello, everyone. I'm very happy to be here to talk about the Wildlife Trust Habitat Banking Investment Model. I have a few slides, which I'm going to try to share. And so it is. So before we actually talk about the actual development of the business case, I'm going to provide a brief recap and introduction to the Wildlife Trust investment model, and try to give a bit of an overview of the project that we've undertaken with the full Wildlife Trust with support of the NERF program, and try to give a sort of quick overview of the different activities, but also a recap on the objective. As I forgot to introduce myself, but I'm Allan, an Associate Finance Earth. We're an employee-owned social enterprise. We're a regulated financial advisor and fund manager, and we've been, as some of you may be aware of, we've been working across a range of NERF projects, working on sort of different habitat type and different ecosystem services. And this one was particularly focusing on the development of the biodiversity net gain market in the UK. So we've been working for, I think, the past 18 months now, working with 4 Wildlife Trusts to develop an investable business model to develop Habitat Bank ahead of the national legislation implementation on biodiversity net gain. For those of you who are not familiar with it, the biodiversity net gain policy will mandate property and infrastructure developers to compensate for biodiversity loss on a specific area, either by creating new habitats and so generating transferable biodiversity units, or purchasing biodiversity units generated from off-site habitats. So the intent of the habitat banking model was to develop potential pilot sites that could deliver biodiversity units over time to meet future demands. I won't go into detail as was work stream, but the initial intent of the project was to sort of start with objective setting and scoping, trying to understand potential demand, try to understand what could be done, what can the Wildlife Trust do in the specific context, and working around the specific policy to assessing the different options, for investment, moving on to develop a specific investment case, and then working on structuring and implementation. As a quick recap on the objective, our goal was to develop a habitat banking investment model to enable delivery at scale. So working with specific pilot sites at first, with the intent to replicate that to all the sites in the future. Our second objective was to obtain indicative commitments from buyers and investors to enable the Wildlife Trust to deliver habitat making pilots. And I'm very happy to say that our project was effectively quite successful. Surrey Wildlife Trust managed to secure more than 1 million of BNG unit sale in the last few months. And it was the same for BBOUT. We secured around 400,000 pounds of BNG unit sales as well. And as for engagement with investors, we also managed to reach a head of term agreement for potential sites with Cheshire Wildlife Trust, and have developed a specific investment case for Warwickshire Wildlife Trust. And one of the last objectives was to share learning to support replications scaled across the Wildlife Trust. And I feel like this session today is also part of this objective. I won't go into detail here, but just to give you a bit of overview and think color to the different sites we've been looking at. So across the different wildlife trusts, we've been looking at 6 different pilot sites, and this presentation will focus on 3 of them. What's been interesting is that we've been looking at sites with very different characteristics between sort of 45 and 60 hectares. One of the sites focusing on rewilding of wetland mosaic, and so near natural reserve, while other sites were more focused around the restoration and creation of new habitats from a specific area. One of them was a former golf course, and the other site, Half Mill, was agricultural land and trying to convert it into a biodiverse site. Again, before I move on to the development of the business case, I just want to also provide a bit of an overview of the different sales strategy and the different approach. And sort of talk a bit about methodology and the definitions. So, as you may be aware, DEFRA has published a metric which enables a property developer, but also BNG site developer, to assess the potential biodiversity uplift on a specific area, and it's called the DEFRA metric. The DEFRA metric uses specific factors, so the number of hectares, the distinctiveness, the condition of the site, the strategic significance, and it also applies specific temporal and difficulty multiplier to calculate the number of biodiversity units that can be generated and then sold. One of the key feature of the DEFRA metric is the ability to generate more units at a time when selling units from a habitat that has been developed and that has been considered fully restored. And that's what we call post-enhancement units. So the 2 approaches have different advantages. So, for instance, selling units before habitat restoration can, usually lead to a lower number of units being generated, but it also implies that the investment requirement is minimal because the BNG site developer will sell units upfront rather than selling them over time, while a post-enhancement approach, so selling units after the habitat has reached a target condition, implies that we can possibly generate more units and with possibly a lower break-even unit price, but that also mean some other things considered, because it possibly brings more exposure to market risk and demand risk in the future, and also leads to a higher investment requirement. But again, that's been one of the features we've been looking at as part of this project, and try to assess how can we bring investment into this project rather than selling units upfront, as we've been seeing in other markets. And that's a bit of an illustration of how we've been thinking about developing so-called investment model. So the way we've been thinking about it the first step would be to provide investment into habitat restoration in advance of development impact, and then we use the revenue received from the sale of biodiversity units to developers to create a revenue stream which can then be used to repay investors. And to illustrate the previous point, one of the key findings around projects was that the post-enhancement approach could generate more units compared to a pre-enhancement approach because we're not applying these specific discount factors. And what's been interesting is that in some cases, for example, for the site in Warwickshire, is that the number of units can actually be more than doubled, which then has some implications around the effective business model and how we factor in cost and revenue. Moving on to the business model and financing requirements, I have sort of drafted this specific slide which talks about sort of a step-by-step approach and how we've sort of tried to analyze and try to assess different sites, different pilot sites. So the first thing that that the Wildlife Trust have been doing that we've been sort of working with the Wildlife Trust on this specific approach is a site assessment. And it's probably it's the foundation and the basis for all the subsequent analysis. The Wildlife Trust have been doing fantastic work, also doing the gathering data for specific pilot sites by looking at the ecological baseline and site characteristics. We also did some assessment of the local BNG demand to see if there was some potential to actually sell units over time. But then I think the main things that was really important in our analysis was to build on the evaluation of targeted intervention, draft habitat management plan, but also the cost estimate over 30 years, because the BNG policy implies that habitat has to be maintained for at least 30 years in order to be eligible. So the Wildlife Trust have been gathering costs in a lot of different ways. Some Wildlife Trusts have been sort of working with ecologists in-house to gather specific cost data, so assess the time that will be required to maintain the site, that will also be able to restore the site and do the monitoring, etc. While other Wildlife Trusts have been working with external consultants who've been doing all the ecological assessments, and based on that have derived a 30-year profile of the potential cost required for first restoration, as some of these costs can be quite high, but also maintenance over time based on specific quotes or based on time estimates. Site assessments also led to the calculations to assess the biodiversity unit uplift using DEFRA 4.0 metric. Well, before a few months before it was DEFRA 3.1, but it was also crucial to understand how many units can be generated and what is the potential for revenue. Before moving on to the next step, I think one of the key things I want to emphasize on is the development of the financial models. So we have been working in parallel to site assessment and parallel to all the habitat banking site assessment step. We've been working to develop a specific financial model, trying to replicate and use the underlying DEFRA data to then have integrated cash flow model, which would allow us to again assess cost over time, but also revenue over time, and that really helped us come up with an overall financial assessment, making sure that we were considering all the potential costs, all the revenues spread over 30 years. So this model was, I think, really helpful. It was, I think, also very important because it helps us refine different assumptions, help us try test out different sensitivities. And it was very much, I would say, an iterative process, because we started with an initial view of what the model should look like, and then we just constantly kept refining it based on feedback from Wildlife Trust, based on also the, as the project progressed, we realized that some features were more important than others. But that was, I think, the foundation and the basis of our assessments. From the initial data that we gathered and from the financial models that we built with the Wildlife Trust, we then moved on to the financial appraisal phase. And again, that was, I think, also a critical. It was a critical piece, based on previous data. It helped us assess revenue and cost over time and analyze under what condition the product would be viable. For example, by assessing what would be the potential break-even price of BNG units through different sales strategies, so either the enhancement, post-enhancement, or sometimes even using a hybrid approach by selling some of them upfront, selling some units over time. The model really helped us assess what the optimal sales strategy was based on the cost profile, but also based on the underlying habitats. As for some of them, the discount multiplier used by the DEFRA metric are more significant than others. And so the flexibility built into the model really helped us try to come up and assess different scenarios and figure out what were the sort of optimal approaches for each of the underlying sites, which was each of them having very different characteristics. I think as a general conclusion, I think for most of them, we end up thinking that a hybrid approach would probably be the most appropriate, by selling some units up front to potentially meet current demand, build relationship with property developers, and then sell units over time. After that, so after looking at the financial appraisal, we then looked at the outputs and the investment assessment, and based on this sort of 30-year cost and revenue profile, we did an evaluation of the funding gap and the investment need based on the selected cost and revenue scenario. So I'll show in the next slide sort of an indicative view, but an illustration of that. But we effectively had some specific pilot sites where, we had very high upfront cost requirements, but would technically generate units in 5 to 10 years, as that implied a quite significant funding gap. And based on that, we then try to assess the potential for each of the pilot sites to repay investments and the different financing options available for them. And after that, engage with potential investors, and again, did an iteration of the model based on sort of investors' interest, but also based on sort of the investor preference. So, for example, when we sort of looked at the engage with investors for the Cheshire Wildlife Trust site, we ended up speaking to an investor who was really interested in more interested in having sort of repayment profile in short time frames, that it would allow him to recycle its investments quicker. And so we initially thought that sort of a longer time frame would be more suited, and so that's when we did some sort of further model iteration and iteration of the business case to effectively try to assess whether or not that could be feasible under sort of a shorter time frame, and then work again with the investors to try to negotiate the head of spends. So overall, I think these are sort of all the main steps that we took to sort of build the investment case. We then again sort of drafted I think a detailed business case across the different pilot sites. But to illustrate that a little bit, this is just an indicative view of the cash flow and the investment need across the different pilot sites, and so building on all different steps from the previous slide. So as you can see here, for 2 specific sites, we realized that there was a quite high funding gaps that would be needed to cover the initial cost. Some cases land acquisition, in some of the land restoration and maintenance for the first few years before any units are being sold, or before a meaningful number of units can be sold. In some other cases, for the case was the Giebelt site, the sites, because it was rewilding, implied a low upfront cost, and costs which are spread more evenly over time, which limited the need for external financing if a portion of units can be sold in advance of restoration, and it's effectively what happened. Then again, the forecast of sale of biodiversity units provided an opportunity to raise third-party investments that could then be repaid as biodiversity units are sold over time. The last point, I think the key advantages of an investment approach is that it can possibly free up unrestricted grant funding, because in some cases, people have been looking at some site acquisition using grants, or using grants to cover part of the restoration cost. And I think what we thought about the investment approach, where you could simply bring an investor on board to cover most of the costs until the project is revenue generating. The other advantage was that the project could generate long-term revenue to cover for the lifetime maintenance, accelerate project replication and scale up, and also enable strategic delivery of strategic habitats. I will probably stop there, Helen. I think I have views of project learning, but I'll stop there and stop sharing my screen.
Yeah, it's really, really interesting. And thanks for being so thorough. We record these sessions, so I'm sure people would like to sort of go back through them again, because I know there's so much you've captured in a very short space of time. I really appreciate it. And I do encourage people to ask some questions. So there's so much you can learn from this particular project, especially if you're working on B&G. So please do post your questions. I have a couple before we come on to Tom. And one was, so I hadn't realised, I think, before, about the patient loan piece and that there were different models. I wonder if you can just sort of share what was the difference and why was one a patient? Why did one work for a patient loan model and the others were slightly different?
I think what we had in mind at first is that because biodiverse gene, it's usually the time frame to generate biodiverse genes can be quite long and can also happen under specific time frame. We thought that patient loan would probably be more appropriate because sort of a longer time frame would allow the product to generate revenues over time and repay investors as the habitat matures. I think for the and taking the example of Cheshire Wildlife Trust, I think the sort of longer time frame would have been viable, but it just wasn't the preference of the investor. Right. And so that's why we sort of shifted towards a shorter investment time frame, simply to try to accommodate the. But I think overall our view was that sort of a patient loan approach could be something quite suitable because revenue are especially for habitat banking, because revenue are usually happening at specific time frame. As I think a fixed repayment profile wasn't the more suitable.
Yeah.
Simply because of that.
Yeah, that's super interesting. Is that public information who made that loan?
I'm not sure I can disclose that, and I think
don't worry.
And I think also one of the presented case study about Cheshire and the site reached so I think we sort of managed to sort of reach ahead of Stern, but I think the unfortunate conclusion was the site was eventually sold to another was sold to another third party before we could finalize it.
All the best will in the world. So much work goes in, and then they can fall down at these last moments. Now you also talk. So maybe let's then talk about the need to be flexible. And obviously, we've had there's been changes to the metric, for example. How have you managed to sort of build that flexibility into as you're developing the financial models? It sounds like you've got an incredible model that you've developed. It'd be great to sort of offer advice to projects on how you build that in.
Yes. So I think what we've been trying to do, and I think the change in secondary legislation has actually just also shifted to thinking a little bit, because we had made some specific assumption, and it was one of the very exciting things to work ahead of policy implementation, try to come up with a specific model. But again, it's also realized that sometimes policy do change, and we have to adapt to it. I think the way we built the financial model was aiming to be more or less flexible. So we had built in the DEFRA. We just actually brought the DEFRA data into a specific financial model, and then sort of managed to effectively update it when the DEFRA metric came out. So I think it's just more around the structure. I mean, I'm not entirely sure I can sort of offer any sort of advice. It was mainly based around Excel, but it was. I think also just trying to make sure that things can get for future iteration model, we'd have to make sure that things could be easily transferred. And I think one of the main changes around the secondary legislation was sort of change around how DEFRA thought about the sale of units over time and what they call the stage sale approach. And so I think that's what I think the I would say the advice I would offer, and the way we thought about it with the Wildlife Trust, was recognizing that there has always been some uncertainties around the specific model, and so trying to build contingencies around that. So try to make sure that when we assess, we did site assessment, we built some contingencies for the cost. We'd also built some contingencies around the potential revenue, trying to, let's say, come up with some specific percentage of units that say, we might not be able to sell them, and so try to assess a model on that basis. Try to be sort of a bit conservative around the assumptions, and that's probably how we approached sort of evolution and thinking around that.
Brilliant, thank you so much, Alan. I've got more questions, but I can save them in case we don't get questions in our Q&A later. Again, I do encourage people while you're munching on your sandwiches to type in your questions. But we'll leave it there for now. Thank you so much, Alan. And Tom, maybe if we can come on to you, I wonder if you could maybe sort of walk us through a very different model, again, one that's been adapted over time, so super interesting. And then we've got a couple of questions for you too before we open it up.
Yeah, sure. And thank you very much, Helen and Phoebe, for the invite. It's a privilege to be on the call. So my name's Tom Dillon. I work for a company called Regenerate Outcomes. We're in a similar space to Allan in terms of raising private finance for biodiversity and carbon market projects, if you like. So I'll just share my screen. Hold on. So in 2019, we set about a proposal which was based partly on the environmental impact bonds which were being developed in the US, which were focusing on essentially, if you like, a kind of natural catastrophe scenario, be it a forest fire or a flooding event which seriously damages river systems, etc. And the environmental impact bonds were being issued to essentially raise finance which would go towards slightly riskier, untrialed approaches on the ground, which public money was slightly more averse to investing into, if you like. So in those cases, for example, you had the quantified ventures, clean water bonds in Washington, DC and other places, and the forest resilience bond in California. And essentially the basic principle is under the bond, you identify a metric which would be monitored over time, and the beneficiaries of that metric would agree to essentially paying effectively a coupon on the bond based on performance over a long period of time. So, for example, on the clean water bonds, it was essentially cleanliness of water as a metric. And we thought this would be a good way to transfer into the UK context and bridge the gap between the finance worlds and the farming community, which essentially was facing various headwinds with subsidy changes and such like. So the idea was back in 2019 that this would be a kind of impact bond approach, and we would essentially employ farmers as contractors to deliver the outcomes which would benefit various beneficiaries, be it locally or nationally. And then the bond would be repaid as we measure and monitor over time. So there were various question marks at that time in terms of how do we help the farms and how do we monitor and verify the outcomes. So we were scrambling around trying to think of best ways to do that. We reached out to Gabe Brown, who's a very well experienced regenerative farmer in the US, and had a number of conversations with him about how do we support farms in this process. And he stressed the need for education, essentially a kind of long-term education approach, because farming, there's day-to-day decisions, there's some strategic decisions, and those decisions should be informed by a clear understanding of soil biology and some of the methods which are being trialled elsewhere, which could be trialled on your farm, but perhaps there are barriers to adopting those practices. So we went about updating our model, using a pilot project in Northumberland as a starting place, so a number of farms up in the Tyne Valley, which we've been working with, and very grateful as well to DEFRA for the NEIRF grant, which supported us in this stage. So how it moved on was very similar in terms of broad structure. I hope you can see that. Hold on. In terms of a cycle of investment being raised, going towards farmers as the agents, if you like, on the ground, and then we monitor and verify outcomes, which would then in turn go back to payback investors. A few adaptations occurred in this process. The first was that a debt type structure would be very challenging because of the lack of data. Luckily we had some private equity expertise in Regenerate Asset Management, who've been our partners and are related entities to Regenerate Outcomes, obviously. So essentially it moved into a kind of private equity approach where we would identify clusters of farms and manage those clusters with SPVs, which were capitalized by the equity investors. So it kind of switched in that regard. And then we kind of built on the middle two columns here in terms of how do we help farms. We would basically collect a lot of above ground data and below ground data, and then partner up the farm with the mentoring team, with Gabe Brown and his team, who are very experienced and very practical. So they don't spook farms by telling them to jump too far. So it's a very nice adaptive system which farmers respond well to. And then we have just finished our project design document for VM42, which is the Vera standard for soil carbon, which was developed in the US, but is now obviously applicable elsewhere. So that is the standard for our, which would generate our principal revenue stream in verified carbon units. This hasn't been done before, so we've been trying to work with a highly prescriptive box ticking process in Vera to get that high standard, but at the same time allow for an adaptive management system with farms. So we think we've come to a good point now where it can kind of do both, but we'll tell you in a year's time. So essentially, we do offer to help farms with other ancillary outcomes such as biodiversity net gain and water outcomes depending on location. But the interesting dynamic here is that we're very much focused on productive farmland. It's not so much taking land out of production. So it'd be interesting to actually talk to Allan at some point about this, but essentially, the idea is that we're helping farmers farm their productive land with principles which are based on understanding ag's system of education. So this is a slightly different approach, and it's going to be harder to bring on board planning authorities and building developers potentially. But we're working on that this year, and but essentially in terms of key learnings, sorry if I'm going too long. In terms of key learnings, our original approach was thinking about a single metric to measure, a bit like the US bonds. It doesn't really work over here for what we're trying to do because of the adaptive management system on the ground. So we scrapped that, and instead we have put trust in that mentoring partnership between the mentoring team and the farm. And if the mentoring team senses a farm is kind of just going rogue, if you like, they'll report back, and there are mechanisms for us to, try to keep that farm in or basically terminate the agreement. So that's different. And in terms of the local beneficiaries of these projects, that's again, because we've been focusing on the Vera carbon standard, the state of play with the legislation changes, etc. It's been difficult to provide a convincing case about measuring and verifying for local beneficiaries, and we're probably a bit underdeveloped there. But obviously you can create a premium in the Vera unit by explaining everything else, all the other social and ecological impacts of your project. So yeah, that's an interesting one, and again, slightly different to what Alan's been doing on the other program. But I'll probably stop there, if that's okay, Helen.
Yeah, thanks, Tom. And it's I know everyone's so interested in this project as well, so thanks for coming on and sharing about it. So just so I understand, you mentioned that debt wasn't going to work because of the challenges the data not being there? Is that because, well, I wonder if you can just explain that. And then I was wondering, on the private equity model, what is the cash flow that's paying back I mean, what's the
Okay.
Yes, thank you.
Yeah, just in terms of, just on the debt side, it may well turn into a kind of debt-based model, but Chris Heathcote, one of our team, he's very experienced in the debt markets, and essentially he realised that there just isn't the data to be able to bring that type of investor on board at this stage. So that's slightly the nuance there, which we can elaborate on another time if you want. But the principal revenue stream, essentially, the Vera standard, we draft our project design document, which is a very detailed document about how we're going to manage the projects. Vera then review that, and a validation body is brought in as well as part of that process. And provided we comply with that project design and Vera authorize our project design, we can then generate verified carbon units from both modelled and laboratory measured soil carbon. So there's a shorter term cycle of modelling carbon with a pretty chunky discount for uncertainty. And then you've got a longer cycle of say 4 to 5 years of actually measuring soil carbon in the ground by a validated approach. So there's various steps of validation and verification, but essentially you generate the verified carbon units, and then each farm will have its own sub account of verified carbon units, and the project takes a minority share to pay for all the costs which we're providing for the farms without charging.
I see.
And then if the projects do well, there's a dividend for investors. So that minority share is not the investor share, it's actually going towards all the costs. So farms don't pay for anything. And yeah.
That's really interesting.
There was a question. Who's auditing farms?
Yeah.
Yeah, so we have annual visits to the farm, and essentially, interestingly, the validation and verification body, they deal with very, very big farms in America, which are quite often performance farms, where there's huge amounts of data. Our farms aren't like that. So we're giving the farms the Soil Mentor app, which is a great app for day-to-day observations and notes in the field. And then, as I say, the mentoring team report back, because they have the finger on the pulse, if you like, for those exchanges, and then combined with an annual visit, we're pretty confident that we'll probably pick the rogue farms.
That's fantastic. I mean, and also there's just a thought of Gabe Brown wandering around farms up north, also kind of terrifying. It terrifies me. He's such a larger than life character. Yeah. I can't imagine him on being on our soil and us not all feeling him here. He's just such a great influence. It's,
absolutely
fantastic. And also I find this really interesting, you know, the whole, it's not land sparing, it's sort of working with the farming. I was at a conference this week, and a fellow panelist just said there's going to be a big decoupling of land use and food production, and that we'll move to all vertical farms. And I just thought that's terrifying to me, and also probably not a message you really want to start putting out there.
No, and actually we're trying to help the small tenanted farms as well. So we started with, it wasn't the big estates. It'd be much easier to do this with the big guys. But all our farmers, most of them are small tenant farmers, and they're especially in the uplands, they're pretty serious risk of declining margins and such like. Yeah.
Well, I've got a couple of questions here, and then we'll open it up because and bring Allan back in. And Alan's got questions for Tom as well. You know, we could have more of a conversation as it's fairly quiet in the Q&A. Let me see. Oh, I think it was just sort of yeah, maybe this is to both of you in terms of just thinking about the audience we have today into the NERF projects and those who watch the recording. They're going to be projects looking at developing business models and getting investment ready. Were there any particular sort of experience and skill sets that you've realised over time that were needed that helped you put this together? And maybe, Tom, if you want to answer first, and Allan, I wonder if you might think about that. I mean, you're a huge team at Finance Earth, but if you could sort of share that.
Me first.
Yeah, please, Tom.
Yeah, sure. It's actually communications in our case. There's so many bear traps in communications with farmers. That's a deficit which we've improved a lot, put it that way. And there's plenty of finance folk out there, but actually it's communicating how that works with the farm, and that's a really important bit. It's a lot of effort and subtlety and integrity. That seems to be an important bridge to make. Essentially, you've got technical and finance, if you like, and the farms are such a different language. So communications, I'd say, you need good communications team, or someone who can communicate very well in that regard.
Yeah, that's really helpful advice. I know that we've noticed that ourselves, just as we work with different stakeholders. Go for it, Alan.
No, I would tend to agree, Tom. Especially, I would say for the case of Wildlife Trust, it was probably, less important because we didn't have to engage with farmers, and it was more engaging with all the stakeholders. But I think communication was also key because it was trying to present what we're trying to do, trying to talk to local planning authorities, trying to talk to potential buyers. And obviously, I think communication is key because sometimes even potential buyers and property developers, they weren't really familiar with the biodiversity net gain or habitat banking concept. So it was, I think, part of it was education, trying to convince people, trying to talk to them about a model, their approach. And I do think communication is key. Apart from that, I think it just to develop business case. I think, what was a key aspect was just, I think, the collaboration between the Wildlife Trust and the work that we do at Financers. The Wildlife Trust have a huge wealth of expertise in ecological assessment, managing site and natural reserve. So they do hold all the underlying knowledge and background on how to develop a specific project, maintain sites, and everything that's required to carry out a project, which has been incredibly helpful as part of this project. And I would say then, in addition to that, I think the financing approach and looking at the revenue and cost, and which I think is also key. So just, to me, it's building a business model and investment case as probably sort of a holistic approach, and looking at sort of different skills, trying to bring different skill sets to the same table to try to develop something in common.
Yeah, and you can see how these projects start to get expensive because you've got expert ecologists who want people on the ground who know those stakeholders, the real specialists, and then you've got the finance and the technical piece as well. It's it's like such a amazing swathe of expertise that has to come together for effectively what quite small projects.
Yes, exactly. And I would say that's, we all think incredibly grateful for that the Nerve project was effectively developed, because we even realized that we saw plans on specific resources around the project, and we ended up actually using way more resources than we expected, even in terms of time commitment from Wildlife Trust, because the project took a long time to develop, and the grant was extremely helpful in getting us really as far as we can, but realized that there were actually more resources committed in addition to that.
Yeah. Well, maybe and I see that Sally's got a question. We'll come to that in a minute, Sally. I've seen it. I guess it's, when we think about the evolution of revenue models for nature restoration, or a shift to regenerative farming, or farming that's nature friendly, whatever the specific words you want to use, do you see that it will speed up? And if so, how? These projects feel so unique and individual, and you're really dealing with, every farmer is individual in what they're looking for in a different business case. So I wonder I'd love to hear from both of you how you see this scaling, and what collectively we can do to help that scale, if anything. Alan, do you want to go first?
Yes, sure.
Throw this one on you. Sorry, new questions.
I think scale is obviously a very important question, and it's obviously we've sort of been developing pilot sites, but the question is, how do we then replicate that across others? I think one of the key things we've been trying to do as part of the of the Wildlife Trust was to share learnings across the organization. So I think it's one thing, and I feel like, well, I've been trying to do through the webinar, try to share learnings, but I think what will be important in the future is that we can sort of make sort of models accessible to a wider range of stakeholders. I think farmers are really, farmers are probably, a key user, probably sometimes even deliver BNG, but it's a matter of trying to make it accessible, possibly also the right sort of finance to support these activities, but also trying to bring them on board. So I think education and access to finance probably the key items for me.
Right. Tom, any thoughts your end on how we, are these very unique, and how do we scale them up if we even can?
Yeah, absolutely. So the method in our case, the Understanding Ag are the mentoring agency, and that's Gabe Brown and Ray Archuleta and all these very experienced regenerative farmers. So they have a principles-based approach which can apply to any type of land and any type of farm. And they consult over 30 million acres of farmland globally. So essentially, if the problem is with some of this is if you go too prescriptive, there's a history of prescriptions failing, basically, because as soon as you take that payment for an action away, the action can often stop. But if you have a principles-based approach, you start to understand the causes behind your actions, and then that drives change for reducing costs on a farm, which is a very primary driver for farms, by reducing their input costs, etc. But the principles-based approach is hugely scalable, and it works. It's proven to work. So that's what we're betting on in any case. But there's resistance from the status quo in farming. There's no doubt about it, and cynicism about regenerative farming. But there's time will tell. We sense the farms are super interested from, as I say, that core efficiency of production margins, also biodiversity, with their children putting on their trouser legs, and they see elms as complementary, which is nice, because therefore has given us some good reassurances that elms is going to tie quite neatly into this. So there's various factors, but hopefully we'll see an acceleration. Yeah,
that's certainly true. I'm not sure if you start threatening people with a future where we all live in urban areas and it's only vertical farms and everything else is gone, then people will move quite quickly. So just a couple of, thank you, Sally, for populating our Q&A box. Thank you, very appreciative. Looks like there's one for Allan and one for you, Tom. So Tom, we'll do your one first, and we'll come to Allan, and then I think we'll wrap up. And it was, how do you get farmers to engage? Was it basically an idea which supports their core business? And you just mentioned it's always a cost reduction, which was appealing.
Yeah. So a few things. There's no upfront cost to joining the project, which helps. They respond well to Understanding Ag. It's a very good team of regenerative farmers who have done it before, so they respond well to that. There's an potential additional revenue stream through their majority share of those verified carbon units, and then there's that core production margin enhancement potentially, because a lot of the soil analysis we do is designed so that the farmers can understand how to reduce input costs. You can't just say to a farm, reducing input costs is a nice idea. There's some technicality to that, which Understanding Ag help with. So that's that on our side.
Yeah, thank you. And Allan, are you able to take Sally's question on the 30-year part? And just for the sake of the recording, I'm going to read it. Were legal agreements covering 30 years part of the development work with the wildlife trusts?
Thanks, Helen. Thanks, Sally, for your question. The answer is well, yes. We've been we received support from NERF to actually look at the legal requirements to set up habitat bank and sort of biodiversity again project. So as part of this work, we effectively looked at the sort of legal implications. The legal agreements weren't drafted, so we so we didn't really draft a full-fledged legal agreement as part of the project. I think be about because they've managed to secure a specific sale in the South and Vale local planning authority, had to set up a specific legal agreement for that. So the answer is we considered some legal advice, but we haven't got to the point for most of the slides around drafting an actual legal agreement.
Brilliant. Thank you. So to wrap up then, as I'm not seeing any more questions here, and I know that we prepped in our prep calls a whole bunch of questions. So I wonder if there's anything either of you wanted to sort of close with, whether it's sort of, you know, comments on general about this market and how you think it's going to go and forward looking, and where, you know, is it Soul Carbon? Is it BMG? What's coming? Or Alan, just any sort of comments for you on tips for as people are developing a business case specifically around BMG? Just to put you on the spot before we close, anything you wanted to share that we didn't get to today?
Well, I hope I was able to actually convey, well, there's a key learnings from the project. I would say that the important thing that we tried to do with the Wildlife Trust was to get something that could be replicated and scaled up. So we tried to apply thinking around specific pilot site, but the idea was then to have something that can be used for all the sites, and the Wildlife Trust have been already sort of looking at all the potential opportunities around BNG, and I think that's probably one of the key, the key learning from this, that we try to build something, but also bearing in mind that it would be hugely beneficial to have something that can be used for other sites and then scaled up for BNG delivery across England. So I think that was one of the key learnings and the key thing I tried to and I want to share around the setting up a specific business model. Again, I think it's just trying to obviously it's dealing with uncertainties, so inflation, cost, revenue, and I would say just trying to factor in. It's always just trying, not be conservative, but try to factor in all these different implications, and so policy, trying to factor in policy evolution, etc., and be as realistic as possible.
Well, thanks, Alan. And crikey, Tom, yeah, on inflationary costs and factoring those in down the line, that must be a big one for farmers. Anything you wanted to close us out with before we let you go, Tom?
If there's one takeaway, maybe we didn't tell our original project stakeholders, the original pilot farms, how much things would change. And so there's a bit of deal fatigue there, if you like, on their part. It's probably advisable if we're starting the concept to tell everyone that this is going to change, just so, because that's just the nature of what happens. And that's probably one of the mistakes we've made.
That's really, really helpful. Thank you. Well, thank you both so much for giving us up your lunch hour and all the time you take into preparing for these webinars. I know it is a lot, so really appreciate it. Thanks for sharing your learnings. And thanks to those for listening. And Sally, thank you for all your questions.
Thank you, guys.
Thank you very much for the invite, Helen.
You're very welcome. Thank you so much. We will, it's recorded. If we can share slides, we will. And just let you know, the next webinar is on the 20th of June and be looking at governance structures. So please sign up where you can. And obviously, please do offer your feedback to Alan and the NERF team on what value you get out of some of these webinars and the other COP work, so that we can better adapt them for you. Thank you all. Have a lovely afternoon.
Bye.
Thank you, everyone. Bye.
Bye.